Happy Tuesday, everybody. I hope you all had a great long weekend, especially honoring those who gave the ultimate sacrifice so that we can have our freedom. So today is May 27th, 2025, and this is your Tuesday, short week ahead market update. Markets opened in the red last week on Monday as Wall Street reacted to Moody's surprise downgrade of the U.S. sovereign debt, knocking the U.S. from AAA to AA1. That initially spooked investors, triggering a rise in treasury yields and a wave of selling at the open. Sentiment was further weighed down by the weak Chinese eco data, with April retail sales and industrial production both missing expectations. We also added in renewed tariff and AI related tensions between Washington and Beijing. However, a recovery took hold by mid-morning, driven by three key developments. The People's Bank of China signaled fresh support for their economy, saying that they would maintain a moderately loose policy, and they cut deposit rates. Number two, the White House played down the Moody's downgrade, calling it a non-issue for long-term fiscal health. And then a phone call between Presidents Trump and Putin signaled renewed momentum on peace talks around Ukraine. Of course, that changed later, but that did, at that point, ease geopolitical tensions. Fred Head Logan's comments about risk in leveraged Treasury trades briefly cooled the rally, but late afternoon headlines that the Treasury was not particularly concerned about the downgrade reignited the risk-on sentiment. Investors shrugged off the downgrade by the end of the day. The Nasdaq led thanks to the strength in mid-cap tech, in mega-cap tech, while defensives and dividend players did lag. The Dow was up 0.25%, the S&P was up 0.1%, and the Nasdaq was up 0.5%. On Tuesday, as was once said, and on the seventh day, the market rested. Markets faltered Tuesday as sentiment soured in response to disappointing earnings from the major retailers. Target, Carter's, TJX, they all cited margin pressures from tariffs and weakening consumer trends. Although early losses were modest, the mood shifted more decisively negative by afternoon. Traders were also rattled by the lack of progress on Trump's proposed tax extension bill, with murmurs of Republican infighting, especially from the so-called SALT caucus, dampening hopes for quick passage. That uncertainty kept a lid on equity markets, despite some positive headlines about global trade progress with India, Japan, and Vietnam. Late day weakness was triggered by a slide in Tesla shares following Elon Musk's cryptic comments on a delayed robo-taxi rollout. That reversal in Tesla dragged down the broader Mag 7 group and turned a midday recovery into a sharp sell-off in tech. Defensive sectors like utilities and staples were the only pockets of green. Growth-oriented and cyclical names did underperform. Bond markets remained calm, but traders were already bracing for the critical 20-year Treasury auction on Wednesday. The Dow was down 0.25%, S&P down 0.25%, and the Nasdaq down 1.5%. Wednesday was the worst day of the week for stocks. The trigger, a disastrous 20-year Treasury auction that I just mentioned, that saw soft demand and a yield tail of over 1 full basis point, sending the 10-year Treasury yield above 4.6%, its highest level since February. Earlier in the day, stocks had tried to bounce on optimism about proposed EU-US trade framework, which included a 0% tax proposals on both sides and scheduled meetings between President Trump and House Republicans. But those positive headlines could not offset the sudden spike in bond yields, which trigger automated selling in both high growth and rate sensitive sectors. Remember, the retail investor is no match for the algos. This was one piece of important evidence in that. The S&P 500 broke down below technical support at 5,900, closed below 5,850, a concerning sign for those momentum traders. Apple also added downside pressure after AI-related M&A concerns emerged late in the day. And for some key context, the sell-off wasn't about poor earnings or weak economic data. It was about the fiscal outlook and rising deficits as markets began to price in the possibility of the so-called big beautiful bill, continuing resolution to fund the government and extend tax cuts, as it could be more deficit negative than anticipated. Investor sentiment turned sharply lower, with defensive trades catching a modest bid. The Dow was down 1.75%, S&P down 1.5%, the Nasdaq was down 1.25%. The markets did show sign of some stabilization on Thursday following the previous day's dramatic decline. Positive earnings reports from names like Snowflake and Urban Outfitters did help lift sentiment early, while reports of cooling services inflation in Europe helped ease global growth worries. That said, concerns about the tax bill's fiscal impact remained front and center, with investors closely watching how SALT deduction negotiations and other spending provisions might affect the overall deficit. While the 10-year yield hovered around 4.58%, its momentum did slow, giving stocks room to catch their breath. Technically speaking, the S&P held support near 5,850, a key level, as I mentioned, watched by traders. Though the relief was modest, the lack of further deterioration in bond yields gave bulls a small psychological edge. This did not seem like a true rally, but more like a pause in selling. So traders did seem to be on the edge ahead of Friday's job data and potential weekend negotiations in Washington. The Dow was flat on the day, S&P 500 also flat, and the Nasdaq was up 0.25%. U.S. stocks declined on Friday as investors reacted to escalating trade tensions. President Trump announced a potential 50% tariffs on all European Union imports and proposing a 25% tariff on smartphones manufactured outside the United States, directly impacting companies like Apple. These announcements intensified concerns over potential trade war, leading to broad market declines. Despite initial drops, markets partially recovered later in the day as some investors speculated that the tariff threats might be a negotiation tactic, surprise, surprise, rather than imminent policy changes. The Dow was down a bit over 0.5%, S&P also down a bit over 0.5%, and the Nasdaq was down 1%. For the week, the major indices posted notable losses. All three were down about 2.5%. These weekly losses marked the worst performance in 7 weeks, reflecting investor unease over trade policies and their potential impact on global economy. Let's look ahead. As you've heard me say, there is a reason the front windshield is much larger than the rearview mirror. So first, let me say it again. All that I am about to tell you about will be watched, but the social media and the sound bites from the president are more important than all of that. See that? I fought the urge to say that it trumps all the rest of the news, but there I said it anyway. Let's start anyway with the Fed head parade. Kashkari, Barkin, Williams, Goolsbee, Kugler, Daly, Logan, they'll all be speaking this week, and the markets are still paying attention to this. Markets will really be watching for growth, as I've said, in my opinion. This and valuations are the most important in the long term. NVIDIA reports earnings this week. Wednesday, we'll also get some other tech companies, Dell, Salesforce, Marvell, and some retailers, Costco, Dick's Sporting Goods, EcoData. Consumer confidence is out again. I don't think we really need surveys to tell us this anymore. Markets up, sentiment good. Markets down, it's bad. So it seems to be a trend. Wednesday, we'll also get the Fed meeting minutes from last month. Again, not only old news, but in my opinion, unless they're bombshell statements, unlikely it's not moving markets. We will get more consumption numbers. Again, the retail earnings and guidance seems to be better for this. And we'll get the jobless and continuing claims on Thursday. That's actually important also as it plays into the growth, because in many opinions, it'll be hard to see a recession if the labor numbers stay solid. We will see. Finally, the end of the week will bring PCE. Yes, you know it and love it. The preferred index inflation report for the Fed. Inflation report for the Fed. As I've said, I don't think this is an issue, but markets are on autopilot when it comes to what to watch for. So it'll watch it, and so will the algos. Not to glide past a market close day, the news over the weekend was all about the delay in tariffs for the EU, delay from June 1 to July 9. European markets were up yesterday, and we are off to the races today. So let's get into a new short week. I imagine it will be full one, so strap in. For now, please remember, share this video with anyone you think would appreciate it, and more importantly, keep your eye on your plan. Day-to-day is going to be all over the place, as we see. Long-term is what matters. If short-term matters to you, your plan will be different than the long-term, and we really need to talk about that. So have a great week. Check out the last May video on Friday and watch for the new June blog to hit the website by this time next week. Have a great week.